This knocks the socks off most investments. In this episode, we are going to address the question, how does IUL compare to other investment alternatives? This is episode 17 out of 21 in a series titled Secrets to a Tax-Free Retirement. It's a free course. Invest about 4 to 5 hours immersing yourself in education that will empower you to accumulate an extra $1 million that can generate $100,000 a year of tax-free income for as long as you live. My name's Doug Andrew, and I've been a financial strategist and retirement planning specialist for more than 45 years. My favorite vehicle I call the Laser Fund, which is the max-funded, tax-advantaged insurance contract. This whole series has talked about why it's my favorite vehicle and why it passes the liquidity, safety, rate of return test with flying colors, and it's tax-free to boot. That's why in my most recent best-selling book, The Laser Fund, there are 4 pillars where I score investments based upon a scale of 0 to 10 on liquidity, safety, rate of return, and tax benefits. But it's more than just those 4 pillars. So in this episode, I'm going to show you how a max-funded insurance contract, especially indexed universal life, compares to a lot of other alternatives like IRAs and 401ks, municipal bonds, real estate, and what have you. Because inside the book, I have a very detailed chart, and it shows all of the different features that most people would prefer in a place where they put their serious cash. You'll be shocked when you study this how many investments fail in so many of these areas. And so I want you to listen close as I go through various financial alternatives. But for years, when I would sit down with clients and they wanted to prepare for retirement, and I could see that they were headed for a very high tax bracket because they had all this money in yet to be taxed IRAs and 401ks. Or they had money in real estate and their rate of return was a pathetic 2%. And I said, whoa, you can do better than that. And so I would advise them, hey, you may want to reposition some of these non-performing assets or these ones that are not tax-free, they're tax-deferred. And over a period of 5 years, we would reposition them into a properly structured, maximum funded indexed universal life insurance contract, where maybe up to 60% of their income would be tax-free at the end of the 5 years of funding. We would strategically roll money out of IRAs and 401ks, get the taxes over and done with sooner than later, reposition the after-tax money into a vehicle that's going to be tax-free. After I would look at all of the assets they wanted to reposition, I would show them accumulating their money tax-free from that point forward, and then I would show income at the time in life they wanted to start taking out the income and have it last until they were age 120 without depleting principal. Then I would show a comparison to various alternatives. They were often shocked that the money in their IRAs and 401ks, even assuming a yield of 10, 11, 12%, but having to pay tax on the back end, would run out of money at age 80, 85, 87, municipal bonds earlier than that. Whatever other alternatives they looked at, I would highlight when they would all run out of money. And the insurance contract, the Laser Fund, would keep generating the income for another 10, 15, 20, 30 years to age 120. It was a no-brainer. But unless I showed them how inferior the other investments were, they thought, well, golly, is this as good as the others? Or are these really that good? And then they could see the difference over 20, 30 years of an extra $100,000 of income. Every 10 years is an extra $1 million. This is not pie in the sky. So let me share with you some of the criteria besides liquidity, safety, rate of return, and tax benefits to measure how a max-funded insurance contract compares to other alternatives. So in my most recent best-selling book, The Laser Fund, Chapter 10 is dedicated to comparing max funded indexed universal life insurance contracts with all kinds of other different financial vehicles that most people put their money into. And so chapter 10 is titled Comparing Different Vehicles, but it's summarized on page 165. This is why I would love to gift you a free copy of this book so you can read and study these charts. But this is summarized on this chart here, and I'm going to refer to this so that you sort of understand the other criteria. So of course, we go through different types of investments and we look at how they fare as it relates to liquidity, safety, rates of return, and the tax benefits. But also, it's not just tax deferred, it's tax free. Can you deduct what you put into it? Also, is it tax-free when you die, when you transfer that wealth? Is it penalty-free? Because sometimes when you access money out of an IRA 401k before age 59 and a half, there's a 10% penalty. Not sometimes, most of the time. And can you use it for leverage to borrow? Can you use it for collateral, for loans and so forth? Is there a self-completing provision if you get disabled? There's a lot of other factors besides liquidity, safety, rate of return, and tax benefits. So on this chart, we actually go down and compare with all of those features that people want. These are optimal features based upon a traditional IRA or 401k in the market, mutual funds, your home or other real estate, CDs and bank savings, annuities, and how that compares to the laser fund. Now, you can't see this very well, but it's shaded in my book, and it will go through and analyze that an IRA or 401k, it does not pass the safety test if it's in the market. You don't get predictable rates of return. It's not tax-free. It's only tax-deferred. And so you get one advantage. You get to fund it with pre-tax dollars. But those are the only two advantages in there. You cannot access the money without penalties. You cannot use it for leverage. You cannot use it for collateral and so forth. When you go over to mutual funds, can you have liquidity? Well, yeah, most mutual funds you can access your money as long as it's not an IRA or 401k, but it does not pass the safety test, the rate of return test with predictable rates of return. It's not tax advantaged. You have to pay tax as you go, or if it's in an IRA or 401k, it's taxed when you take it out. As far as deducting what you put into it, nope. It doesn't blossom and transfer tax-free. There may be penalties involved, but maybe not. You can't use it as leverage in most cases, but you could use it as collateral for a loan. So there's only maybe 3 positives out of all those. When you look at your home, there are only 2 that are advantageous with your home, because home equity does not pass the liquidity test, the safety test. You can lose the value of your house when the markets drop. Your rate of return on real estate is always 0, and if you don't understand that, you'll need to read my book. And so real estate or your home actually is pretty pathetic as far as these optimal features are concerned. And sometimes people learn that the hard way when things get tough and they can't sell their home and they lose it in foreclosure because it's not liquid, it's not safe, it goes down in value. CDs and bank accounts may be safe, but the rate of return is really pathetic and they don't have tax advantages and so forth. The bottom line is this: when you go through and study this, most of these various alternatives where Americans put their money only have 1, 2, or 3 of these features. A laser fund has all of the features with the exception of tax-advantaged funding. You fund it like a Roth with after-tax dollars. Now, actually, I get my tax deductions another way, but just in and of itself, you cannot fund a laser fund with pre-tax dollars. You can do it indirectly through other strategies. But that is the only difference. Everything else, it passes these tests with flying colors. So I would advise you to study and compare, and especially not only during the accumulation of money, because in every illustration that I've ever shown for long-term investing, a laser fund will grow to more money in most cases. But you don't choose investments based upon which ones grow to the most. You choose them based upon which ones generate the most at the time in life you're going to be using the money the most. And that's why the software that we use illustrates, okay, at age 60, 65, whenever, let's start taking out income, net, spendable income to buy gas, groceries, prescriptions, golf green fees, net after tax and fees. Let's pull it out. Out of a laser fund, $1 million can generate $100,000 a year tax-free. That's your money. In an IRA 401k, you'd have to pull out $150,000 to net $100,000 in a 33% tax bracket. Most mutual funds, you can't do that. This is why other investment alternatives will crash and burn. They will run out of money long before you run out. And so what's the consequence? You outlive your money. That's why I choose the laser fund for my serious cash, so I will not outlive my money, and it knocks the socks off of most other investment alternatives. So this is episode 17 of 21 in the series Secrets to a Tax-Free Retirement. I would advise you to watch this episode next and watch all of them and invest about 4 to 5 hours immersing yourself in this free course. But if you would like to read and learn and see charts and graphs, I would love to gift you a copy of this book for free. I'll pay for the book. You simply go to laserfund.com and you pay $5.95 shipping and handling. I'll pay for the book. You pay for the shipping and handling. It's a 300-page book full of charts, graphs, explanations, so you can learn that way. And also it contains 62 actual client stories of people who have successfully used the laser fund for everything from retirement, college funding, real estate management, emergency funds, business planning, and so forth.